Go, go, go. Oh.
We are
Yeah,
live.
awesome. We're live.
Hello, everyone. First of all, wishing you and your loved ones a very happy and prosperous new year. Welcome to our Capital Mind Live, our weekly show where we discuss everything about markets, finance, investing, etc. Every week, we dive into one topic and discuss that in depth: the pros, the cons,
Everything
the
about
why,
markets,
how,
finance,
etc.
investing, etc. Every
Oh,
week,
there is an
we
echo.
dive into one topic and discuss that in depth. The pros, the cons, the why, how, finance, etc.
Okay, I don't know what. There was kind of an echo of some sort that came back.
Deepak, there is some
Okay, I don't
echo.
know what. There was kind of an echo of some sort
Yeah, yeah, yeah.
that came
Okay.
back.
Okay, okay.
Let's
Pardon me,
figure out
guys.
why. Okay, I'm
Yeah,
going to mute myself. Bro.
yeah, yeah, yeah. Okay. Is it?
Okay, okay.
Let's
Pardon me,
figure
guys.
out why. Okay, I'm going to mute myself. Bro.
Yeah, yeah, yeah. Okay. Okay, okay. Pardon me, guys.
Okay, I'm going to mute myself. Bro.
Yeah, yeah, yeah. Okay. Okay, okay. Pardon me, guys.
I think now it should be fine. Okay. Uh, okay. Sorry again, guys, for the technical glitch. Ha- Welcome back to our Capital Mind Live, our weekly show where we discuss everything about markets, finance, investing, etc. Every week we dive into one particular topic and discuss that in depth: the pros, the cons, the why, how, etc. And having said that, this is not just a show about markets, it's a place of casual conversation. We want this session to be interactive. Whether you are new to the investing world or a seasoned investor who simply wants to learn more about investing, there is something for everyone on our show. This is Krishna from Capital Mind team, and we have with us our very own Deepak Shenoy. Hi Deepak, Happy New Year. How are you doing? Deepak, you are on mute. Yeah.
There you go. Okay, I'm hoping this thing doesn't glitch again. Let's see if it does. But assuming it doesn't, Happy New Year to everyone. So this is a good, interesting start to the year. The markets have been very unkind of the last year, but in the spirit of having a new year, what we're going to do this time is, instead of discussing a myriad of topics, we're going to discuss one topic, and that's it. And then we'll take Q&A in general, which is more generic in nature. But here's we have a topic for this month, this week actually. It's quite interesting. We'll go through it in some detail. More importantly, let's also take your Q&A. I know that we missed the last weekend of the year was lousy, and I was in Australia at the time, so I was down under. The markets were down under, so it was kind of fun. But they seem to have come back a little bit. So let's see how the markets react going forward. I'll leave it to you, Krishna. Take it forward.
Needless to say, Deepak, you have been missed, not just by us, but people on Twitter, on Slack, people are asking that when are we having this live again? Okay, finally we are here on the new year. Okay. Uh, Guys, just take a quick disclaimer before we begin. None of the stocks or sectors that we discuss today should be considered as buy or sell recommendation. They are just simply topics of discussion and should not be taken as investment advice. Coming to our topic, buybacks. Uh, so the thing, what Deepak, I just want to know or discuss about this particular thing, buybacks in depth. What are buybacks? Why would a company buy back its own share? And in what scenarios a company will go for a buyback? Because there are other alternatives as well: dividends, rights issue, etc., etc. And which is better, buyback or dividend? I open it for you, and then slowly we can go. Yeah. Just a second.
Okay, while
Deepak,
everyone's speaking, let's start with some thought processes. Um, Guys, so we have a lot of reasons why companies want to give shareholders monies back, because you're shareholders, you have to get money. So if I generate some cash, let's say I'm a ITC, for instance, and I was doing nothing but doing the cigarette business, You don't need more cash to run the cigarette business. Cigarette run business runs by itself. And ITC and Infosys or TCS, these are companies where cash is generated, but new cash is not needed to run the business. What do you do with it? You sell shares? What do you do with the shares, that the money that you have? You can return it to shareholders, or you can return it to shareholders in different way, or you can acquire other businesses. You can do other things with the cash. Assuming that you don't want to do those other things, what happens next? I think Krishna, do you want to take people through the articles that we've written on this?
Yes, sure. I just want to share my screen.
Sure. Okay, while that's happening, feel free to, yes, thank you and Happy New Year to everyone, and feel free to ask any questions. We're going to talk about buybacks, as in why you need buybacks and what happens during a buyback and what are the opportunities that arise. Mostly, did I quit smoking? Why are you asking that? Is that a problem? Or is that not something that we should be doing? Or so yeah, okay, I'll leave it to you. I think there's some technical issues with the buyback process.
Can you see the screen?
I think I can see something here. Yeah, there you go.
Okay. So basically, just to give you a perspective, buybacks are one of the ways to reward the shareholders. You can actually reward the shareholders in many ways, and buybacks are one of the reasons. Till a couple of years back, the primary way and most popular way to reward shareholders are dividends. However, that scenario has completely tilted. Initially, it used to be dividends, and then few companies will do buybacks and all. But because of the change in the tax structure, buyback has taken one step lead, and dividends are tax inefficient. Just to give you a perspective, let's take a scenario where a company wants to distribute 20,000 crores. And there are two ways. It can distribute either in the form of buyback or either in the form of dividend. Let's take the dividend scenario. In dividend scenario, the tax distribute since earlier it used to be dividend distribution tax, but that was not there from 2019. That has been eliminated. The tax has been eliminated. However, these dividends are taxed in the hands of shareholders. And highest tax slab here is 35.8 and not 42% because there is a limit on the surcharge. Now, if you consider that, I'll go back to our presentation. Yeah, if you consider that a tax in the hands of shareholders at 35.88%, you are effectively only distributing 6,420 crores out of 10,000 crores which was supposed to distribute. But if you take the buyback route, now what happens is that in buyback route, the company will pay tax. How much it will pay? 23.8%. But as an investor, you are not obliged to pay any tax on the amount you received as a buyback. So effective distribution for an investor will be as high as 7,670 crores. As you can see, the difference is high, more than 10-12%. That is primary reason why the buybacks has taken a leap forth and dividends have taken a back. That is one more. And there are a few more other reasons as well. Let me just share the screen. Yeah. Okay. So coming to the first, another question of why would any company buy back? Again, so as Deepak mentioned, it is one of the ways to give the money back to the shareholders. Practically to support the share price. This is one more important part. Let's say if a company, the management felt that the current market price is highly undervalued, and they want either one reason is that the promoters can themselves buy it, or the second way is that the company can buy back its own shares and with that it can increase the EPS. So two reasons can happen. It will protect the stock price from further fall. The company thinks that it is in the value zone. Second, by buying its own shares back, it is actually in a way increasing the EPS, because the net profit will remain same and the number of shares will decrease, so EPS will further increase. So that is one thing. And this is important. How do they buy back shares? There are two ways the buyback shares can happen. One is tender offer and market buyback. Deepak, you want to just to add why there are two ways and which is the better way to do in the same presentation? We can walk through the same.
Okay, so here's what your problem when you do a buyback is. If you're a company that wants to do a buyback, your issue is, I want to return cash to shareholders. But when you do a buyback, you buy back shares, those shares get extinguished, they go out of circulation. So if I do a 10% buyback, if I have 100 shares, tomorrow I have only 90 shares, right? So your new earnings which you get are split over 90 shares, your earnings per share increases by 11% effectively, because 10% of your shares have been bought back. So if I earn 100 rupees per share, I have earned 1 rupee per share, 100 rupees in profits over 100 shares. I have 1 rupee per share as my earning. But if I have only 90 shares, I have 1.1 kind of rupees per share as earning in the next year, assuming that I can continue to earn the same amount. Now, why would I do this buyback rather than pay out a dividend? Like you said, the taxation is higher. But even if the taxation wasn't higher, it would be better to do the buyback, because in one case, I earn 100 rupees every year, I give it to you as a dividend, whatever happens. But the next year, I have the same number of shares. My earnings per share is not going up unless I grow my earnings. Here, I can get a double thing. I can reduce the number of shares and I can increase my new earnings will give me a higher earnings per share. So the share valuation per share can actually increase over time if I keep buying back. The limits, 25% of paid up capital plus reserves. So effectively of the net worth of the book value per share, a maximum a company can do is 25%. Another restriction in India is that if you have a lot of debt, your debt to equity ratio is more than, I think, 4:1 or 2:1 or something like that, then you should use the money to pay back the debt. So they say that you can't buy back if after the buyback, your debt to equity ratio goes beyond 2:1 or something like that. This is one of the reasons why L&T wasn't allowed to do a buyback, because at a consolidated level, L&T contains L&T Finance. Now, L&T Finance obviously has a lot of debt because it's a finance company. So therefore, there's a problem in their debt to equity ratio. There were some modifications to this rule, but by and large, I think somebody asked this question. Is debt reduction a way also to reward shareholders? Actually, it's a way to reward bondholders or debt holders, in the sense that you make money, you have extra money, please pay back the debt. Shareholders may not. I'll tell you one reason why they won't get affected is when, if you have a company that has a certain ROE, that ROE is built out of a natural consequence of equity and debt. That ROE comes from, so ROEs are like this. Okay, so let us say I am a business that earns only 2% margin. Very small. This 2% margin is not going to be worth it. If I take all my equity as 100 rupees and put it as equity, I earning only 2 rupees out of that 100 rupees is a waste of time. So I can do two things. One is, if I earn 2% per transaction, I'll do more transactions. If I do 10 transactions on the same 100 rupees that I have, if I do 10, so I do one every 1.2 months, 1 month and 5 days, I will then be able to do 10 transactions in a year, 10 turns, asset turns they call them. So effectively, you'll turn your equity around 10 times, and you will be able to then generate 20% profits, or 20% revenues actually, assuming that your profits are also low. Now, if that's your margins, 20% margins. So, but what if you can't? If you can do only 4 times, that means once in 3 months you can buy stuff and then receive cash for it and buy stuff again and so on. Then what you do is, instead of having 100 rupees in equity and doing this, what you do is you take 100 rupees in equity, take 100 rupees in debt, you have 50% debt to equity. Now you have 200 rupees. Even if you turn things around 2 times, only 4 times a year, each time making only 2%, you will make 2 into 2 on 200 rupees, 4 rupees per, and you'll be able to multiply it 4 times. 4 into 4 is 16. The 16, you'll have to offset the cost of the 100 rupees of debt that you've taken. Maybe that cost is, to give you an example, just 5%. So you've earned 16% margins, you'll pay 5% to the debt holders, and you'll make 13%, which is fairly okay, because if your debt is costing only 5%, making 13% margins on equity is not too bad. So this is one way. So what happens if you now start earning excess cash? You can't pay down the debt because your ROEs will come down quite tremendously. You should pay that back to shareholders and keep the ROEs relatively higher, which is why debt owning companies also tend to pay back excess cash to shareholders. This is either that, or they use it to increase capacity and therefore take a little more debt on once you've increased capacity and so on. So you there's a multiple reasons why. Now, there are 2 ways in India that public market companies can do buybacks. Public market companies can go and do a different set of things. One of the things is this. There's something called a tender buyback. There's something called a market buyback. In a tender buyback, there is a tender offer. Everybody gets a little paper that says, listen, you have so many shares. We plan to buy back 20% or 10% of those shares, whatever percentage. Sometimes it's 1%, sometimes it's 2%. And you can then say how much, you want to tender. You want to tender, I have 100 shares, I'll tender. You told me I can tender 10, but why don't I tender 15? Why do I tender more? Somebody else who was qualified to tender may not have tendered. So I take advantage of the fact that some people would have tendered less. I'll go and tender more. Maybe out of my 15, 12 are accepted. 10 are what I'm anyway going to get accepted, because that's the minimum. I am eligible to tender 10, but I could give 15, so I can tender 15. Some people tender all their shares, saying, jitna lena le lo, and give me back the rest. In India, there's another complication in a tender buyback, that 15% of the shares are reserved, 15% of the value is reserved for small shareholders, people who own less than 2 lakh rupees worth of shares on the day of the record date of the buyback. So that means if you own 2 lakh rupees worth shares or less, you are come into this qualified category. In this qualified category, if there are less people participating, and even if you tender all your shares, although by definition only 10% of your shares may be eligible for the buyback, because of the low participation in this retail shareholder set, that's called a small shareholder set, you may see 50% of your shares accepted. Now, tenders are typically done for a reason that they save the promoter's taxes. That means a promoter, if he gets dividend, typically is a high net worth person, and he will make in crores, dividends. So dividends are now considered to be income. So they will say, listen, if I get income, I'll pay 42% tax. So if I pay 100 rupees dividend, first of all, the company is paid tax. On top of that, now I have to pay 42%. What's the point? Instead, let's do a buyback in which I will also get my shares. I get to give my shares. So if I own, say, 50% of the company, everybody participates. I also participate. My 50% will also remain 50% because everybody's participated in tendered shares. I will also get this dividend as a buyback. In the buyback, the company pays 20% tax, but you pay nothing. So the promoter is not taxed at all. So it's a good way for them to receive a higher return. Effectively, there's a 20% tax on the buyback, which every shareholder pays effectively. But the promoter, if he had got it himself as a dividend, not as a buyback, he would have paid 42%, which is obviously not a good thing. So they tend to do tender buybacks where the promoters want money. Example, Tata Sons in TCS. Tata Sons always does a buyback because TCS has so much excess cash, 15, 16, 20,000 crores. They do a buyback every year roughly. In that buyback, they say, well, out of that 20,000 crores, yes, the company will pay 4,000 crores as taxes, but let that go. Beyond that, whatever is left will be used for the process of buyback. In the process of that buyback, because 65% is owned by Tata Sons, they make roughly 10,000 crores, all of which is tax-free for Tata Sons because buyback taxes have already been paid. This is a good way because otherwise, if you're distributed, 13,000 crores, 20,000 crores entirely was distributed as dividend. If you distributed 13,000 crores to Tata Sons because they own 65%, they would have taken that 13,000 crores and paid 42% tax on that. Their net return would have been 6,000, 7,000 crores. So obviously that is getting 10,000 crores after tax is better than getting 7,000 crores after tax. So the promoters use a tender offer when they want to get dividends. Tender offer is equitable in the sense it doesn't matter what the market price is. And so what they do is they tend to give the tender offer at a much higher level so that people do tender and get their shares, get paid for it. So if the stock price is at 3,500, they may do 4,000. If the stock price is at 200 rupees, they may do 250. So the idea is you get this higher stock price as a buyback. This is not actually very efficient for the company because the company should be buying back its shares because it's low valued, right? The market may have taken the share price down, but because tender buybacks tend to be replacements for dividends, nobody wants to do tender buybacks, to do low price arbitrage. So the way to do that is prices in the market are low. I think our company is worth more. So let's take our excess cash and buy back our own shares. And in that buyback process, we will buy back at the market price, at the current market price. Now, again, this is a question that whether are you doing this because the price is low, or are you doing it because somebody's shorting your share and you want to keep the share price up? This can be done in the open market. When you do it in the open market, the promoter cannot sell their shares because if they sell their shares and the company is buying it back, it would be considered weird. So the promoter does not get to sell their shares during the time of this buyback, open market buyback. But an investment banker is appointed who then sells or buys back shares daily from the market. Now, if by any chance you have those shares and you decide to sell them in the market, and because you don't know who the other party is who's buying your shares, when you sell the shares, you don't know who the other party is. It could be the company because they may be buying back the shares at the same time. If that is the case, then some of your bought shares could be matched with whatever the company is buying. Then the exchange will send you an email. That email will say, listen, your sells have been matched with the company's buys, and therefore these many shares you should not pay any capital gains tax on because it was a buyback. So you can actually say, go to your CA and say, listen, I've sold so many shares, but so many were buyback, tagged as buyback. So therefore, I don't have to pay capital gains on those. Baki sara you pay capital gains tax. Again, FIFO method and all that. So open market buyback is now, why do companies sometimes use an open market buyback? Because the price is lower. So you don't have to pay a premium to buy back shares. You buy back shares in the market. They typically give an upper limit. That upper limit tends to be higher. So if the stock price is at 400 rupees, they'll say the highest price is 600 rupees. So they'll buy back below 600. Now, again, this has history because there are some companies who said we'll buy back. Any price below 600, we'll buy back. And then, price was below 600, they didn't buy. Then the price starts going up and then the company starts buying. Sort of just to push the price above 600, and then later say, listen, the price went above 600, so we couldn't buy back all the shares, and therefore it's over. So SEBI said, no, listen. If your share price is below your upper limit, every day you have to buy some shares, or every week or something like that. So there's some rule around that. This changes the dynamic for people. The manipulation will no longer can happen, and it's a simple way that the company can buy back shares. Now you will extinguish these shares. We will put all the links in the video summary when this video is archived. You'll be able to find it. So you can see we have written about 4 or 5 articles. So we've got,
Adipa, before we take that question, I have one question. So can a company, let's say, want to protect its share and they just announce buyback, okay? And can they back off in the future? Okay, now I don't want to do
that. They do. I think they can back off until the offer is approved by SEBI. After that, they can't. The money has to go into an escrow account. So the full money should be placed in an escrow account. The investment banker should be selected, and then they should do this. So 2 lakh. Okay, one question is, with this tender offer, is the 2 lakh per face value? It's per market value. So it's not the face value of the share, it's per market value as on the date of the record date. Now, the other thing over here is there are 2 things that you have to consider. First, shares are extinguished. Why do share extinguishments help? If you extinguish shares, the future dividend and EPS and all increases because you take the shares. Now the company cannot own its own shares, so it says cancelled. It's over. I mean, they can own their own shares. I'll leave that for it's a different exercise. But assume that a company cannot own its own shares. It cancels those shares. The remaining shares that are left are all that are outstanding. So that becomes lower. There are no advantages to a split and bonus system other than people think of them as dividends. It's not a dividend. I am giving you the same earnings distributed over a large number of shares. How does it matter? It doesn't cost me economically anything to do this. Therefore, doing a split or a bonus has absolutely no value. In fact, has negative value. Bonuses take the cost value of your new shares to zero. That means your old shares are X and your new shares are at zero. So you may have a loss in the old shares and a profit in the new shares if you sell them today. But the loss could be a long-term capital loss. The profit could be a short-term capital profit, right? Short-term profit. A long-term loss cannot be adjusted against a short-term profit. So you might end up in a situation where if you sell a share after the bonus, you have to sell them 9 months later for them to be, for this to be active. But let's assume that you sell a share 9 months after the bonus. Then the loss that you might incur in the shares that were pre-bonus cannot offset the profit that you made in the shares that are post-bonus. So because long-term capital loss in taxation can't offset short-term capital gain. So it's a mess. So bonuses are actually net negative for pretty much everybody who participates, other than the fact that some people get a lower stock price. They feel a little excited about it. I don't know what that funda is, but why should we get excited about lower numbers versus higher numbers? I don't understand, but maybe that's a psychology behavior that people try to analyze. In fact, the Dow Jones index itself, which is the US index, is a price weighted index. So the higher the stock price, the higher the weight of that stock in that index is, which is a terrible thing to do, but America does it. So I don't understand. But what they do is when the share price becomes too big, they split the share so that the share price comes to a smaller number. I don't know if they continue to do it, but it's a miserable thing to do. So it doesn't add any economic value to anybody, other than the fact that you feel a little better about your shares. Cool. So we should, holding proportion, everything, yes, remains the same. There's no advantage to a stock. So I hope that the concept of buybacks is interesting. So now I think a lot of people may say, what can you do with a buyback? Is there an opportunity? I think I told you about the small shareholder concept that provides a short-term opportunity, but a company that does consistent buybacks year after year can actually give you a significantly higher return than your stock price demonstrates. So if you just take certain stocks that have been giving buybacks or doing buybacks on a consecutive basis, you might find the stock price is roughly the same. But if you take the buybacks into consideration, there's a 30% CAGR over the last 10 years because these companies have excess cash, and that cash has been returned to shareholders almost every year, not as dividends, but through buybacks. In buybacks, you can do only 25% of net worth every year. So they may have 100% of net worth sitting in their bank accounts. They can only do 25% per year. So they do 25, 25, 25. So the stock price goes up only 5 or 6% a year, but your return on that stock has actually increased, quite substantially to 25 to 30% a year. So it may be that, pretty much many of these companies have very defunct or low operations. They have a lot of cash on their balance sheet. So that's another reason.
So eating their own thing, I just remember that Munish Pabrai has a own fund completely dedicated to investing in companies that are doing buybacks. So he called it some Ouroboros fund or something, snake eating its own tail. So over a period of consistently, any company that has been consistently buying, even the business doesn't grow, the EPS grows. So just a continuation of the point which you mentioned. Deepak, shall we take some questions?
Quickly, yeah, let's do it. I think we have some 5 or 10 minutes to do questions. Let's quickly do these. I think, sure. Why is SEBI? So the answer to this is, why is SEBI trying to kill market buybacks? I think a reason for market buybacks to be a problem is because they can be construed as manipulative in nature because the company is participating in the stock market in which its price trades. So if it does any announcement, can it increase the amount of buyback that it does before that announcement or after that announcement? Can it can it signal to participants that, something big is going to happen? These things are, thought processes that go. I don't think they're very well proved, but it's also not equitable to the promoter because they can't participate, right? in the market. And plus, you don't know what price you can get. You don't know whether when you sell the shares are going back to the company or not. It's very difficult to find out. Because you sell on that day, it could be matched against, I don't know, a speculator who's doing intraday trading. And that guy buys it from you and then sells it intraday to the company. It's just anonymous trading. You don't know who's going to be buying. So even if you sell on that day, you might not be the person buying and selling. So you might end up with, you might not be the person transacting with the company. So there's no sure way to know how much money you will make post-tax unless you actually, unless there's a tender offer. In the tender offer, you're sure. So that's a more sure thing, I think. Why they're trying to kill it is possibly, I don't know why they're trying to kill it, to be honest. I mean, market buybacks are pretty much common across the globe. But I feel, it may be these elements that say, well, make it more equitable, do the tender offer process. The tender offer process is a problem because a lot of people who, for instance, your grandfather bought some shares and, you don't even know they exist. They're sitting there over there. If you get dividends, they'll at least come and you'll maybe be able to participate by having this dividend thing happening. But if you're not in the country, you're not available, this participation in the tender buyback is more difficult. Open market buyback happens by default, so existing shareholders benefit through a lower IPS at a later date. Tender market buyback, I mean, of course, you could say that the participation is equal in both cases, but in one case, there may be a better way for shareholders to participate is I think the argument. However, I don't know the actual reason. I think the point is to simplify stuff. I believe at least tender buybacks are more complicated because you have to make some action to do these, and you don't become passive anymore. You become, so during the tender process, you can't sell shares because you've tendered them and you're waiting for them to come back before you sell them. So index providers, for instance, they also have to tender their shares to be able to utilize the buyback. But if in the middle of this buyback period, if the index itself changes, what do you do with the shares that you tender for the buyback? Do you wait for them to come back and then sell? During that time, so it's the tender process creates these complexities. The market buyback doesn't. So I mean, there are pros and cons on both sides. I think SEBI is evaluating. They haven't yet banned it yet. They have made a proposal that says they don't like it, but I don't think that argument is entirely well thought through yet. Perhaps a lot of people will write in and then tell them what their thoughts are.
Okay, so let's move to the another general questions, more general questions. So Ajit is asking, with global liquidity tightening, which was already happening in the last 1 year, do you think equities will remain under pressure? Should we expect lower returns going ahead, especially for this year?
So where are we with respect to the markets? Okay, we recently hit an all-time high. We recently went to nearly 19,000 on the Nifty, and we are now at 17,850. So this is roughly about 5 or 6% below an all-time high. So in India, liquidity does not seem to be tightening, and let me show you why it's not seem to be tightening. And maybe I should quickly present my screen, which is this one. Okay. So clearly we are, we're at a short-term negative point, but let's leave that aside. I'll show you RBI. So RBI actually has a fairly interesting concept. So the concept, well, okay, this is market. I didn't know this. Okay, this is new. There's a money market operations. Let me just increase this. You're looking at a net liquidity absorbed. I mean, this is this is not injected by the RBI. RBI has actually taken away 230,000 crores of liquidity. That is excess liquidity in the system. So there is no tightening happening in India in meaningful ways. Although they've raised interest rates, this number, which had fallen to 50,000 crores, has actually increased to 230,000 crores. That means what was 50,000 crores of excess liquidity has now become 230,000 crores of excess liquidity. In fact, even if you account for some of the past borrowings, which were slightly higher, you're still talking 150,000 crores of extra. So it's not that much excess liquidity to speak about. I think, having said that, I think the world will react negatively. We should also react negatively in the near term. Well, until such point as inflation starts to reverse. I think that will be the end of this year. when inflation starts to reverse, and that's when things will change. But in all probability, we have gone through in India the worst of the tightening part of the cycle, in the sense of where this thing is now. It will be demand that drives some of the things in the future. The rupee seems to be stable at 82.7 or something. The India's 10-year bond is actually increasing in yield. Today it's gone to 7.37. It was at 7.23%. It's gone to 7.37%. So I would say liquidity tightening is happening more in the West than it is in India. Equities could be under pressure. We can't predict the whole year ahead, but I can tell you this, that India seems to be in better shape than the West. So hopefully our companies are able to come out of this situation faster than the West. So whether that happens this year or not, I can't say.
Got it. Deepak, let's take another asset class question, the debt. So Jay Rao is asking, is it better to go with dynamic bond funds or long duration funds right now?
So I remember somebody asked this about a month ago, and I'll give you the views of what I have. So what was 7.23% a month ago is now 7.37%. Now this sounds like a small thing. Oh, it's only 0.16. 0.16% is equal to roughly 1% of the price of the bond. That means the bond which was at 100 rupees will trade at 99 rupees today, simply because the yield has increased. With 10-year bond yield would have increased by 1%. So of course you have 1 month of accrued interest, so it kind of adds in, reduces the loss. But if you look at a gilt fund in the last 1 month, it would have returned very little. I would imagine that most long-term gilt funds will probably have in the last 1 month returned even lesser. Why has this happened? You end up with a situation where a gilt fund that invests in government bonds has to invest in those government bonds, and then the government bond issuances and the fear of what is going to happen in the budget and what is going to either increase. Government bond yields are going to increase or decrease based on market's perception of how these bonds are performing. Now, government bond yields going up means either the market participants think that the government is going to issue more debt, or there is a fear that RBI will raise interest rates even further from where we are. Both are possible, because RBI hasn't said we will stop increasing rates. They have only said, oh, it looks like maybe, hopefully, but the answer to this is, I think rates are still not coming to a stage where they're coming down. Forget coming down. RBI has only in every single meeting increased interest rates, not decreased them. Until they come to, or not even paused, not even said, oh, enough. If they come to a stage where they say enough, that may be the point where you start getting into long duration. Dynamic bond funds or shorter term funds may be a better play, because right now, rough example to say is, listen, 2-year bonds, 2025 bonds. Today in the government, which is about 2025, is trading at maybe 7%, roughly 7%, 7.1%. The 10-year bond is trading at 7.37%. So the difference is very, very tiny. Earlier, this difference used to be as much as 1% difference between the two. In fact, just 1 year ago, the 1-year bond or 2-year bond would trade at maybe 5%. And the 10-year was trading at 6.5 or 7%, nearly close to 7%. So you had a 2% differential between the 1 year or the closer term and the long term. Today, that difference is just 0.17, 0.27 kind of percent. It's much, much smaller. So playing the 2-year, 3-year duration may be better until such time as the RBI changes its stance and at least decides to pause. Once it does that, I think we can make a call that, okay, you should get into longer term duration funds. So till then, I would say be careful. Though, to be honest, my view changes on this based on the market, because if the market yields go to 8% today, I'll say, listen, it's worth taking the bet. At 8% or even 7.8 or 7.9%, I don't see much more downside on yields. So, chalo, trade risk le lete hain. But right now at 7.37, it's neither here nor there.
And for someone who is for senior citizens or someone who is in the lower tax bracket, the banks actually are giving higher FD rates than this one. Of course, there is a tax thing in our mutual funds. We have indexation benefit, which is not there on FDs. But yeah, Deepak, we'll just take last 2 questions, please. Your view on auto sector? What do you think of auto sector right now?
So actually, the auto sector is not very. Look at the two-wheelers, okay, Bajaj or Hero. They're not doing anything. TVS also has come down from its top. And the sort of two-wheelers are not doing so great. M&M is doing well. I think Tata Motors is kind of. I don't know what is Tata Motors doing. So I can't. I don't remember the last time I saw Tata Motors share price. But yeah, it's also not doing anything. M&M, I think the M&M's funda is it's not just a motor company. There's so many things that go around with it. We own it, so honestly happy for us to have the stock go up. But I feel here it's not only the motor company dynamics at play. Though, to be honest, I have booked a car from M&M 2 months ago, and I've been asking them if they will give me delivery at some point. They have not, because I think there's so much demand. So maybe M&M cars being in demand are also driving some of the stock price up as well. Dynamics here, I think agri products have done well. We're looking at a very strong increase in tractors year on year in the last couple of months. Commercial vehicles seem to be doing well. Both Ashok Leyland, Tata Motors, the CV part of things, and M&M CV part of things have seemed to have done well. The weakest seem to be the two-wheelers, and slightly better than that is the four-wheelers. So given this dynamic, I think at some point this will switch. But when, I don't know. I mean, I'm hoping it happens. But a CV and a tractor switch is more business-oriented. Personal transportation, which is two-wheelers and four-wheelers, seems to be more related to how rich people feel. And other than the high-end cars, I don't see the demand of the low-end cars or two-wheelers increasing in a dramatic fashion right now. Data doesn't say it. I hope it happens. I'll just say I don't want to predict when it will happen.
Right. So one last question. Actually, I'm just combining two questions, which we can't skip on. Two people have asked on NASDAQ 100. So your views on NASDAQ 100, Deepak, another 52-week low, it has been doing in the last 1 year. So
yeah, I mean, things in the NASDAQ aren't very good. We're looking at NASDAQ of, say, I don't know what the NASDAQ is at, but the Tesla itself has fallen 72% in the last 1 month, 1.5 months, so 1 year, I think. It's some crazy number, and it was one of the largest market cap companies. Now it's become much smaller. You've got a lot of companies that have shrunk, and one of the reasons they've shrunk is this is a new regime for America. I mean, look at, for instance, the dynamics around search, the dynamics around e-commerce. Amazon and Google are one of the top players, and even Facebook is beginning to advertising. The dynamics here seem to have slowed down, and the slowing down is a result complication of both higher interest rates, competition, fragmentation. Advertising revenues are moving in different. I mean, people's eyeballs are moving in different levels. Earlier it used to be all Google. Now it is Google and a little bit of this and a little bit of that and a little bit of this. So Google is no longer the space you go in for news, for instance. News is probably Twitter. Is a better source for a lot of news than just me speaking, but I've noticed that the quality of news is much higher there. AI, the GPT thing, is changing things from a perspective of, if I want meaningful answers to questions that I have, which require longer answers, instead of looking for an article, I'll go to ChatGPT and just ask, and it will give me a stuff. Tomorrow, ChatGPT will also give me links to other articles which kind of have a lot of this information as well. People are using different mechanisms to get stuff. So they're moving more into apps, and apps may not necessarily have advertising in them per se. So if engagement is being driven by mechanisms which don't have ads, the people whose business is advertising will obviously slow down. So you're seeing slowdowns in Google, you're seeing slowdowns in Amazon, because shipment, both startups falling and startups conserving money is reducing their AWS revenue to some extent, but also that e-commerce transaction revenues and retail revenues in the US have slowed down. So I think we are going through the slowdown phase. I would say, instead of trying to pick bottoms, wait till the market recovers. You lose the first 10%, let it go 10% from the bottom, and then you'll be able to pick a better time to kind of invest. it's going to be a very long, it's already been a long kind of winter for it. Literally from the beginning of next year to now, or last year to now, it's already been down. So give it some more time, I'd say. Then you can always buy it when things look better for the US than to look at it at a time when things don't. And the stock prices are the biggest indicator, right? The prices are telling you that this is not a great time to invest. If you're at lows, there will be one low. It was when it was the best time to invest. But a stock typically makes like 10 lows, each one lower than the other. Those earlier 10 lows are probably not great times to invest, right? So you can only be right once, exactly. And if you're trying to pick the bottom, I would say don't bother. Wait till you get to a higher high on the Nasdaq, and then start to pick it up. You'll lose the first 10%. No matter what you do in a deep downturn, that's exactly how much you lose.
Awesome. So guys, that brings us to the end of this week's session. Please let us know how we can improve further. We have been constantly improving this session, this particular Capital Mind live session, and put it in the comment section below. We'll try to implement them. And for the questions we haven't taken because of the time constraints, we'll make sure to add them in the next session. So that's it from us. Do like, share, and subscribe to Capital Mind YouTube channel. Thanks for joining, and happy weekend, everyone.
Thanks so much. I hope, wish you all a great happy new year. We catch you guys next week and have fun. Have a good weekend.
Thank you. Thanks, Deepak. Thanks for your time. Bye, everyone.
Cheers, buddy.